I'll just share a few thoughts more around macro, and then I guess we'll go and open it up. So I think really when we look here, we're in very interesting times. We're in a new world era. And I think there's, when I think through my life, I don't think we've really experienced times like, quite like this. You've got a situation where you've got Trump on the other side, China on this side. You've got state capitalism in China. Then you've got a resurgence of private capitalism. You've got Brexit in the middle. You've got this driving wave on nationalism coming through. People unsatisfied with the governments, what the governments are doing. And then you've got Africa fighting for attention somewhere in there. And that story I'll talk a little bit about, but there's a lot of optimism around the Africa story. And also when we think about the aid and the foreign direct investment, how that has changed from being OECD-led to more Asia and China-based, and the implications, I guess, for the country as we move forward. I think if we zoom in here, this again just shows, again, the advantages that Africa really hosts. And you can see the journey that we've had here in terms of the way we were first portrayed as the hopeless continent in the early 2000s. Then there was the whole Africa Rising, then Aspiring Africa. But now we're at a space where people are really questioning the strength of Africa and all that they hoped, because we were often compared against the emerging tigers of Asia and how that growth had actually come through. And I think if you look between 2000 and now, and you look at, say, for example, the per capita income changes, they've not been as quick as maybe the experience was in Asia. Yeah? And I think that's largely really around governance and some of the other issues that we talk about on a day-to-day basis. But fundamentally, you've still got this 1.2 billion people who are 1.2 billion consumers, second largest population in the world, 3.3 trillion in GDP. But what's exciting is we have three of the world's fastest growing countries. Yeah? And the question is really, how do we transform that into creation of more jobs and improvement of the lives and livelihoods of the people who live in these countries? And I think just moving us along, what this slide is showing here is when we think about Kenya, Kenya has been fortunate through a series of specific interventions, plus also our location, to have got global attention. And what's exciting is that Kenya is second to South Africa in terms of foreign direct investment, which is a material change in the past. And that's reflected there by the number of projects that you can see, 85 projects in terms of foreign direct investment into the country. And I think it's one of the new corridors to sub-Saharan Africa because of our geographic location. It gives access as a base, going forward. And it's a fairly diversified economy. And coming to the foreign direct investment, one of the things that came out, and Alikan, you were with me in this very hotel, is Nairobi has now surpassed even Johannesburg in terms of foreign direct investment, which I think is a major milestone and shows really the positivity in terms of which people are thinking about that. And that's reflected here on this slide in terms of many multinationals setting up base here in the country. And you can see 30 global multinationals. And that, I think, is encouraging because what happens behind that means people come here, they move here, they set up offices, they rent space, they rent houses, they employ people, which I think is part of the global story as we move forward. Now, just taking a step in terms of the banking industry and some of the trends that are there. I think after the financial crisis in 2008, the industry changed forever. Yeah, we saw financial meltdown, and I'll share with you the impact of that financial meltdown. And we saw then a resurgence of regulation in a way that the financial industry had never seen before. And I think as that has happened, that has had real consequences for banks, especially international banks, in terms of the way they run their businesses. Because if you think about, say, banks in the UK, where the government had to bail them out and pump in taxpayers' money to keep them afloat because they were too big essentially to fail. And they were pumping in their government money to bail out businesses that had taken risks in other parts of the world. And that's where I think they came in and said, why should we be risking UK taxpayers' money, if you take the UK as an example, because of your decisions that you made in the US? So they started putting in lots of regulation, lots of capital buffers, and it became much harder in terms of the minimum thresholds on returns that were expected. So you've seen essentially a reduction in many of the balance sheets of these international banks. And we're still seeing the reverberations of that even up till now, as banks really start focusing on how they can give returns to their, to their shareholders. In the process of that, we've seen a change in the financial industry players. We've seen now fintechs really coming in because they have filled a space that banks were not literally providing. And that is really coming out very, very strongly in terms of products and services. And you just need to look to China to see the extent of some of the organizations like Alipay and Alibaba and all of these type of companies, what they've been able to do for clients, because they've found a niche, they've found opportunities to which they feel that they can serve clients better. And banks were struggling because they were trying to meet regulations and compliance. They were not in a position to be innovating as quickly and to be as relevant to their client bases. So they are also able as fintech companies to build scale. And that has presented a challenge. So you've got leadership of banks where you've got ROEs that are actually dropped. For example, the pre-financial crisis, the ROEs were in the region of 22%. Those dropped in 2009 to 3%. Yeah, now they've edged up a little bit. If you look, they're probably in the region of 9%. But the ROEs are still less. The return on equity is still less than the cost of equity, which presents another problem. You've got increasing regulation. You've got increasing capital requirements. You're not delivering a return that's covering your cost, you're covering your cost of equity. So would you want to invest in those institutions, or would you want to invest somewhere else where you've got an opportunity to grow your business faster, like a fintech company? So that has really created a lot of difficult situations, for bank leadership to actually manage. And you've got shareholders demanding those returns and saying, why are you participating in South America? Why are you in some of these European businesses? Why are you in investment banking? Why are you in this? Why are you in that? Because and they were breaking down the level of returns and making decisions, which I will share in a moment. Meanwhile, you've got a market where, if I move this along, where the environment, we call this the great bank robbery here. What this slide is really showing is just the velocity of change that is happening in the market. So on this slide, what it just shows here is the number of years it takes to get to 1 billion users. Yeah. If you start on that, on the one side, the radio, it took 72 years to get to 1 billion users. Yeah. TV, 67 years. Then you've got first PC, 32 years. Then the mobile phone, 20 years. And interestingly enough, the smartphone, 5 years. Yeah. So you've got this scenario where change is now like on steroids. Yeah. It's happening so fast. Yeah. That, even when you think about the way you invest as a business, even from an accounting perspective, you'll say, what is the life that we should depreciate this project over? Normally they'll come and say 5 years, 10 years. Those business models have to be re-looked at, because when we're having these discussions and somebody says, I would want you to invest in this technology, and I think I can do it over 5 years, I'll be like, you'll be lucky maybe if you've got 2 or 3, which suddenly changes the whole profitability dynamics around your investment decisions. So we're dealing in a world that is moving at very high pace, and suddenly technology is changing the way that banks are being run and being managed. Now this slide here just really gives you the impact of tougher regulations on international banks. So essentially what it shows is it shows the market cap of these institutions. So you can see there, like Lehman Brothers, it was in 2007 a $60 billion company. In less than a year, it was non-existent. It was taken out and acquired. Citibank in 2007 was worth 255 billion. It lost 93 billion of value when we look in 2017. At one point, it was worth less than 40 billion. Yeah, in 2009. Yeah, Now it's managed to eke back, is at 162. You look at HSBC, 215, now worth half at 127. Barclays was at 89, is now at 48. So it's very real around the value that was stripped off from shareholders who had invested in those companies. And it still impacts them today. And when we look going forward at what the implications of that are for businesses, these are some of the decisions that are happening on real-time basis in boardrooms in some of these companies. Number one, the level of fines that are being levied on these international banks if you get things wrong can wipe out your profit for years. Yeah? And the consequences of that on leadership and management around the choices they make are quite severe. And you just see a few examples here of organizations which have, have pulled back. And you can see, you cutting 30% of your workforce, Credit Suisse. Even our own bank has had to make tough decisions around businesses that it didn't feel it could get the return on equity higher than the cost of equity. So you can see those there where they've decided to pull out, sell, etc. Now, the interesting thing is, they've actually pulled out, like the closures you can see in the case of Barclays, they've actually closed those businesses or sold those businesses entirely, i.e. they don't retain a stake. For Barclays Bank in Africa, for regulatory reasons, and I'll share with you the dynamics of the decisions, they actually wish to retain a stake, but they just wish to minimize it, and I'll talk a little bit about that decision in and of itself. This slide here, this slide just really shows the impact of some of those regulations on the way they run the business. On the left-hand side of the slide, you look at the assets that PLC had and what has happened just in between 2013 and 2016. We had 1.4 trillion pounds of assets, and they've just in those 3 years shed 300 billion worth of assets. They've just offloaded that off their balance sheet. And that's 7 times Kenya's GDP. Yeah, just to put things in context around what that really means in day-to-day practice. And when you look here, your cost of equity is roughly running at 10.5%. And the CEO's challenge at that point is that he had a return on equity sub 2%. Yeah? So the shareholders will just say, you need to get it above that, and if you can't, we'll find somebody who can. Yeah? So that's just the reality of running businesses in that environment. So when you look at, say, Barclays Africa, which is in the middle there, on the left-hand blue bar, you can actually see that the return on equity for Barclays Africa as a consolidated group was running at 17%. But when you look now at the capital buffers, let's see here. So when you look now at the capital buffers and the requirements of translation into UK when they take their profits back to the UK, 17% becomes 8.7%, which is still lower than their cost of equity. Yeah? That's why they had a decision really around what do we do to get above this hurdle. And they needed to make some decisions around regulatory and accounting deconsolidation. And that's what drove the decision. It was nothing to do with the attractiveness of the Africa market. It was just to do with the fact that they have shareholders who could decide to pull out their funding if they were not getting the desired return. So they've got a portfolio of businesses. I've shown you businesses that they decided to close and get out of to release capital. That's why you saw the 300 billion coming out. And then you've got these where they're saying if they reduce to a point where they can achieve accounting and regulatory deconsolidation, they can drive up their return on equity. So you've got a fundamentally good business in Barclays Africa, which is giving decent returns. On the right-hand side of this curve, or of this slide, you've got the Kenya business, which in 2016 was also giving a decent return on equity, even after the interest rate cap of 17%. So you've got fundamentally great businesses within Africa. So for us, even though there was the announcement that Barclays PLC wanted to sell down its shares in Barclays Africa, not in Barclays Kenya. It was in Barclays Africa that they were reducing their shares. We now have a situation where when the transaction is completed, we will have a very strong Africa franchise, with a very strong parent company with commitment to continue to operate within the African markets. There's been a lot of speculation, a lot of sensational newspaper headlines saying Barclays to pull out, we're going to close, job losses, that there'll be no bank. I mean, we're systemically important in almost every market that we operate in within Africa. You cannot take decisions around pulling out lightly. And if you've got a business that is giving you a decent return on equity, why would you want to close it? It makes no sense. And also if you sell out all your pieces, so you get a one-off benefit, but you don't get a sustainable benefit for your shareholders in the long run. So Barclays Africa Group is still very much committed to all the businesses within the Africa franchise, and is very much committed to the Kenya business. The Kenya business is the single biggest business outside of South Africa, and we've really seen the positives of the fact that they understand the Africa franchise even better maybe than PLC did, given that we live and work in this franchise. So we're really looking forward to the future, as we really move into what I call Barclays 2.0. Last year we had our 100-year, 100-year anniversary, and now we're moving into our second century, as we move forward. One of the questions that I had here was, does anybody know which is the oldest bank in the world?
Yes.
You're disqualified. You are disqualified. You seen my slides. Would anybody hazard a guess which is the oldest bank in the world, and how old is that bank? Any guesses?
Which one? You're close.
Yeah. Close, yeah.
Linguistically close.
Yeah. Any guess how old is the oldest bank? So the oldest bank is Monte del Paschi, yeah, in Italy, and it's 545 years old, yeah. So, and it's still operating today. So it's an interesting one. It's had obviously a lot of swings and roundabouts and highs and lows, through its 545-year history, but it's still around, and that I think is an interesting lesson to say, how do you survive? Because today, if you look at Fortune 500 companies, FTSE 500 or FTSE 100 companies, they normally say that they're not going to last more than 20 or 30 years. So in your lifetime, can you imagine a situation where Google doesn't exist? Or Microsoft doesn't exist? Some other company exists in its place, yeah? So we can't. We think it's not possible. But the reality is when you look at even how the Fortune 500 makeup has changed over time, many companies have dropped off. The big steel companies which were there in the earlier part of last century are not there. They're not even making it, yeah? They're all tech companies, service companies. So we cannot take for granted longevity and survival. And for us, this slide really just brings home also the history really of Barclays in Kenya. We've been here 100 years. And honored to be part of this, the fabric and the culture of this country. And we have a series of firsts that we're proud to have been part of and to have helped with the financial industry. And we've just highlighted a few here. Clearly, we started in 1916. And then we've got there a picture of Dr. Mary Okello in 1972. She was the first Black African branch manager to be appointed. I'm also very honored her photo is there because she's my aunt. So it's interesting how life evolves when I can talk to her now, when she tells me all about how banking evolved, where women were not allowed to borrow without their husband's consent, and all of those type of stories, where they played their part in terms of driving to what we have now. And we should not take it for granted what they actually did in terms of their contribution. And you've got a number of other things. We were the first to introduce ATMs. We're one of the first banks, if not the first, to introduce Islamic banking or the Islamic banking window. And we've had many other firsts that we've taken. Some of the recent ones that you've seen in the press was the gold ETF, which we announced a few weeks back, which is the first exchange-traded fund to be launched in this market. So we really are trying to we've had this history of firsts, and one of the things that I'm trying to do is to bring back that issue of being a trailblazer and a trendsetter, within the Kenyan market. Now, just in terms of our journey, very quickly here, over the last 5 years, what we've really tried to do, and I'll share with you the strategic imperative we've had, and how we've achieved this is we really wanted to transform the bank. Not incrementally, but literally transform it. And just in the last 5 years, we've moved from a stagnant place of growth where we were actually declining. We were not actually growing our balance sheet. We were decelerating to a point where we've grown our business, and we could almost literally have a bank that's half our size that's been added on during the course of the last 5 years. And I think that's due to a lot of the efforts of the team within the bank that I've been fortunate enough to work with. We've invested significantly in our communities. 500 million shillings has been invested in community-based initiatives, and I'll talk a little bit about that. And we also take pride in trying to promote the country of Kenya through Barclays Kenya Open, and to promote sports and competitiveness in there. And we continue to be committed to doing that. So it's above and beyond just golf in and of itself. It's really around promoting the country as we move forward. Now, in terms of the banking industry, very quickly, these are just a few key themes that are there just to kind of throw out, and we'll probably pick this up a little bit more during the Q&A. Regulation is key. Interest rate caps, very, very real to us as bankers and very real in the economy. In terms of the economic cycle, where are we now? We're going into elections. We are now seeing, you just open the newspaper and you see inflation levels where they are. They've now crossed the 10% mark. It's really having an impact on people's lives on a day-to-day basis and their standard of living. So we've got this scenario where you've got digitization, models changing, necessitating banks to keep up. Also, there's the question around number of banks. Do we have too many? Should there be consolidation? You've got this era where we've had Chase and Imperial Bank. So you've got questions around governance, and how should that work? So ultimately, there's also now the requirement of new business models which are return-based, not absolute profit-based. Yeah? So it's quite a difficult environment in which to operate, but in there are opportunities in which we can make money and give money back to the shareholders, while hopefully making a difference within the communities in which we operate. So this was a slide which really just talks about what our strategic focus is. And I think one of the things that I've said to the team, one cannot ignore digitization. Digitization is here to stay, and with the improvements in computing capability, we're really investing a lot in digitizing the front end of our business. We want to use process automation to really drive efficiencies and straight-through processing to improve customer experience, and also to take out cost so that we can pass those benefits on to customers in terms of cheaper banking services. Because one of the things you can be sure is I never get people saying banking is too cheap. So I think we have got a scenario where there's always that pressure. Can interest rates come down? Can pricing come down? And we need to use technology to really try and pass those benefits on. Ultimately, everything we do has to be customer-led. So we've got very strong agendas around driving customer experiences, and I'll talk a little bit about that and putting the customer first. And then, more importantly, when we think about all of this, there are two things. I'll talk about community, which I've mentioned before. We really believed in shared growth. We believe that our success is pegged on the success of the communities we live and work in. We cannot be successful at their expense. So we really have this shared growth phenomenon where we build in how we can make a difference in the communities whilst hopefully giving a good return to our shareholders. But ultimately, it comes down to performance. One of the things we have to do is to make sure we deliver a good set of returns for our shareholders. And that has been part of the significant focus that my team and I over the last 3 to 4 years have been focusing in on. Now here specifically on this slide, this really just shows what the experience has been so far. When I came in 2013, we set out an agenda which was really to, number one, kickstart the bank. When I came in, the bank was seeing a deceleration of its balance sheet. Assets were declining. They were in the negative territory, minus 1%. Liabilities were growing at a rate of 0%. So the first thing was to say, how can we get that growth rate into the teens, if we're going to grow our revenue? So it was, how do we grow our revenues faster? That meant balance sheet growth. It meant diversifying out our revenue base. How do we grow? And that way we can grow profitability. At the same time, we had the challenge where we needed to deliver profits, but the business had been underinvested in. The technology platforms were a little bit antiquated. So we really had to spend a lot of time and energy upgrading everything. From servers, PCs, routers. We refreshed our entire ATM network. I can safely say in the last 3 years, we've literally replaced every single PC that is out there. All our ATMs, our 250 plus ATMs, have all been replaced. We've introduced new technology in terms of internet banking. We've got into the mobile banking space. We've got into agency banking, because these are all the modes that customers want. So we're growing our revenue base. We're investing in our business. And as the regulations allow, we've got into new businesses. So, for example, bank assurance. Regulations did not allow international banks to sell bank assurance products. When they opened that up, we have now got a new revenue stream, and I think we're third largest in less than 2 years in terms of bank assurance sales. And yet insurance is so underpenetrated at 3% of the population. So we've got these huge opportunities. We've got into stock brokerage business, which you saw also towards the end of last year. Again, there's lots of opportunities for investors to really invest in the markets we've got. On the efficiency side, because of the investments in technology, we're now seeing, we've got to simplify the lives of our customers. So one of the things we've done is we've gone paperless in terms of the customer experience. People always say, why do I have to fill so many forms at the bank? And they're quite right. Yeah, you fill so many forms when you go to the bank. The question then is, how can we simplify that? So when you walk in, even when you want to make a deposit, you literally just give your check or you give your money to the cashier and you sign on a digital pad. So that takes out a lot of paper, which is good for the environment, it's good for cost, but it's good from a customer experience. And the investments we're making to simplify customers' transactions. When we were looking at an account opening 3-4 years ago, that account opening was taking us sometimes 2 to 3 days to complete end to end. But by investments in things like iPads and our infrastructure, we moved that from 2 to 3 days to less than 15 minutes real time, where with one iPad, we can literally get everything. We can photograph your ID, we can get you to fill an online form, we'll email you those, and it goes straight through to the creation of the account. So that's the kind of transformation that we're looking at. It does take time because you have to invest in the technology, but now we're starting to see those results. So when I look at the balance sheet, we've been over the last 2 to 3 years growing in the double teens. This last year, we actually had the fastest growing asset book in this market, growing at 16%. Liabilities are now starting to pick up. Are we where we want to be? The answer is no. We obviously still would like to extract more of the returns from our investment, but we're encouraged by the fact that our business is actually moving, and we're encouraged by the opportunities that are there. Just the last few slides before I wind up. I talked about service. It's easy to say, it can be theory, but fundamentally, service has got to be the core of everything we do, and the customer has to be in the center of all of that. I mentioned we had to invest in the core architecture. The reality is we were suffering with our system stability, our system uptime, and there is no point investing in the customer experience if your core fundamental service isn't working to the extent that you'd like. We're now at the point now where we're focused much more on customer experiences, that you encounter. Like I said, paperless is one, but also how you encounter our staff and colleagues as they deliver that experience to you. So there are very specific culture programs that we're working on, and we're training, and working with our people on how to deal with change. Because one of the biggest challenges that is there as a leader is, how do you deal with all of this change? And I think this is something which I'm sure we'll tackle. And many people are fearful of change, the rate of change, digitization. So we sort of in a sort of friendly way, we kind of ask people, are you still in the analog world or are you in the digital world? And everyone wants to believe they're in the digital world, but they're still analog. So I think those are some of the things which we're looking at, and we're looking at how do we use channels to be available for you 24/7, 365 days of the year from wherever you are. So that remains a core focus. Now for us, the other thing which I talked about was our shared growth and community agenda. Shared growth is something that is embedded in the core of what we do and how we do it. We've got 2 programs that are that are core to what we do. One is Ready for Work, and I think here, Ready for Work is really how do we prepare young people for the workplace or to set up a business. And I think we have core pillars which are indicated there, which are training people around, do you have the necessary skills to manage money? Yeah. What are accounts? How do you use accounts? The different types of accounts. How much should you borrow? Yeah. Then there's core skills around, how do you prepare yourself for a job interview? How do you write a CV? How do you write an introductory letter? Yeah. those type of basic skills are lacking in our education and education curriculum today. So somebody comes out technically strong from a university, but doesn't have the skills to convince people to hire them as they go out there. So this online platform has certification tools that you can go through to achieve that. And then we've got other things in there around entrepreneurial skills, things you should think about as you're thinking about starting your own business, because everybody wants to be the next Bill Gates, but hasn't done what it takes to actually bridge the gap around their skill sets. So that's one program, Ready for Work. It's been quite successful. Last year, we took 94,000 people through it. This year, we want to take another 400,000 people through that program. And we'll be working with the government to try and see how we can embed this, in terms of their digital agenda as we move forward. In terms of scholarships, that's a new area, especially with our transition now that we'll be investing in. We'll be also sponsoring students to go through certain programs, so you'll see a lot more of this going on. So this will actually take them through tertiary education and look to placing those same individuals into companies that we will partner with so that they can get jobs after their tertiary education. So this is something we're spending over 100 million this year, and we will continue to invest in going forward. So it'll not just be take you through school and then leave you at the end of that. It will be hopefully also to place you thereafter in a good job where you can contribute. Now, just moving on, for us, we've got a very aggressive and exciting agenda around diversity and inclusion, and this is something which I personally am very passionate about. You can see the pillars there around diversity and inclusion on the right-hand side of the curve of the slide. But if I just talk about one, which is gender, we've made a very focused effort within the bank to try and get greater parity for women in the workplace. And we're very excited that with the support of my chairman at the time, Francis Okomo Okello, we were the first company on the stock exchange to achieve a 50-50 board diversity agenda ratio. I believe we're still the only one who actually has that ratio. And I can safely say, there's complete parity and processes in the workplace which ensure that women are treated equally than men. There's still a lot of things we have to do. It's not to say that it's by any stretch of the imagination perfect, but I can simply say at the basic level, there are no discriminations around pay for women versus pay for men, opportunities for women to be given jobs that are senior, and that's exciting as we move forward. We additionally also have an agenda for those who are physically challenged to try and see how we can integrate them into the workplace, because many of them have a lot to give and contribute, and we're trying to see how we can move those forward. And we've partnered with both of these initiatives with various parties, New Faces, New Voices, Gracia Machel, Zuri Awards, and we're really trying to give young people that opportunity as we move forward. Now, last couple of slides. I think the exciting part going forward is really around innovation and sort of digital inclusion. There's a lot of exciting things we'll talk about during the course of the Q&A, which is really around how we use automation, big data, artificial intelligence to transform the way banking is done. I think we're only at the beginning of that journey. And as I say, the way the fintechs are going, we are also investing significantly in that. And we have a very active innovation agenda within the bank. We do hackathons, ideation, and we've taken new product development forward on that side with very exciting products that we will be launching soon. So as my last slide before we get into the discussion session, personally, I wish I was younger now. I still think I'm young. My kids don't think I'm young, but that's another story. But I think there's no more an exciting time to be embarking on your career. There is no more an exciting time. The reason being, the rules of the game have entirely changed. There are less boundaries now than there ever have been before in terms of what you're able to do. You can start a business at any age, doing anything, and creating products and services that can allow you to achieve your aspirations and your goals. So I think it's really what you make it fundamentally in terms of the choices you make and the ambitions you have. So I would only say don't limit your aspirations in terms of your career, and really go out and get them. I think at the same time, as we do so, we have to do so with an authenticity as a leader. Use your own style, embed EQ into the way we do things. I think quite often I see people who are focused on IQ and technical skills, and they underinvest in the softer skills to be able to read situations, to convince people to back them, to buy their product, as we move forward. So I think one needs to be tenacious, one needs to be alert, one needs to be conscious. I think this is the day of conscious, enlightened leadership. It's not just about leadership, yeah? And how do you evoke change through your own leadership in this country? You can be successful as an individual, but if we're not successful jointly, we're going to have a problem. And I think that's one of the challenges we have as leaders. So I think one needs to use all the connections one can, networks, to be able to achieve the goals that you want. And I think we talk about disruption in the business context, but I often don't hear that people talking about disruption in terms of your personal career. Yeah? How often did you disrupt yourself? How did you push yourself into a different angle or career path that you previously were on? Because otherwise the who moved my cheese starts kicking in. Your success has got you to a certain point, but the question is, that success may not get you to the next point. And are you ready to disrupt yourself before somebody else, younger, faster, fitter, smarter, comes and takes you out? Because I see a lot of people with a victim mentality. Yeah, I was good, I achieved this, I'm entitled to this because I've worked 25 years to get this. The world doesn't care about entitlement. Yeah, there's nothing like that anymore. Yeah, the better, more relevant leaders, players will be the ones that will survive. So I think that's really a question that I would throw open to you as we think through your careers. Be tenacious, be courageous. I mean, I would love to see young people leading this country in a different direction, where we see the benefit and we see the uplifting of people and their lives to a place where we can really be proud, rather than a little bit embarrassed by the things we read in the newspapers on a day-to-day basis. So I think maybe Ali Khan, I will stop there. Thank you.